Hello, and welcome back to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir, and for our first episode of 2024, I'm joined as always by Alan Higgins. We're going to be looking ahead to the three things investors need to know. Before we get to that, a few little bits and pieces to sort of catch up on. Well, first of all, Happy New Year, Alan.
Happy New
Merry
Year to you,
Christmas,
Sarah.
I guess. Yeah, how was your Christmas and New Year?
Very nice. I didn't get socks this year.
Didn't you?
I
You were
got a
skiing, weren't
jumper.
you?
I got an upgrade. I got a jumper this year. How about you?
Well, funny enough, I'm meant to be getting a jumper, but it hasn't arrived yet because they've sold out. But I bought myself a Christmas present. I bought myself a wetsuit because I think we've talked about before my love of bodyboarding. So I've
I think
decided to
that's
buy
brilliant.
myself a wetsuit.
We're going to have to get you to the Gower Peninsula. For those who know it, a cheap Cornwall. Cornwall's
Yeah.
lovely. Get a Cornwall.
Mm.
But good surfing there.
That's what I've heard. Yeah, that's now I've got all kit. I can just jump in the car and go whenever I want to. That's the plan. Anyway, all right then. So, I mean, obviously we had some couple of sort of our sort of last few episodes. We were looking very much at 2024, but 2023. I feel we should know that we've had the complete year. It was a pretty good year for investing, wasn't it? In the end,
It was, despite everything. Do you remember how pessimistic
I
everyone was at the
know.
start of the year, especially about equities?
Mm.
We'll come to this, but we really struggled to find anyone bullish of equities, didn't we, Sarah?
We did, yeah. Certainly in the
Really,
first half of the year.
yeah. So call out to Tom Lee of Fundstrat, well-known name on CNBC and Bloomberg, but not so well known here in the UK. Him, but I really can't think of anyone. And so equities obviously performed, and then bonds started to perform right at the end of the year to kind of end up where they started. So you ended up earning a reasonable level of income actually from
Yeah.
bond portfolios.
Well, that said, now I'm reflecting back on something when we were on with Richard Way, we talked about the Santa rally and then what happens in January, and you were quite positive about January in the US. However, Howard Sparks, our US equity expert, he came to us, didn't he? And he said that usually the first day's trading in the new year is the most volatile for US markets, and sort of he was right, wasn't he?
He's sort of right. Yeah, there was a big down day for the Nasdaq. Less so the Dow Jones and even the S&P 500, but there was movements. And yeah, so it was a volatile big down day, a 2% down day for the Nasdaq. Not in the direction that investors like necessarily, but so a bit of a volatile day.
But why was that? So you said the Nasdaq. Is this the Magnificent Seven? Has the gloss worn off the Magnificent Seven?
Oh, that's a big statement. That'll be a whole podcast in itself. But just as it happens, you are partly right. There was a big downgrade of Apple from the Barclays equity research team, and basic premise is Apple's different from the rest of the Magnificent Seven. It's not really growing, yet trades at 30 times earnings at a real premium. And Apple, with its big weight in the index at 7% of the S&P 500, I think it ended up down 3% alone, maybe even 4%, that stock. And that really got people a little bit cautious. It can be quite hard for markets to rally when Apple is that weak.
I did see, I was reading actually talking about forecasts, which we're going to be talking in a minute. I was reading a piece in the FT yesterday, and there was an argument that Apple is probably one of the few of the Magnificent Seven that is not really embracing AI or generative AI. And I wonder whether that's part of that downgrade, do you think?
It can be, yeah. I mean, look, we'll see about the future. It's just the core business of dominated by iPhones. By the way, we should say in all humility, that we know much less about Apple compared to those of you who pick US stocks and are analysts and people like Howard Sparks in our own team. But the argument tends to be it's still fairly hardware orientated. I mean, any AI benefits are to come if there are for Apple. But let's leave that for Howard to debate the pros and cons of that in the future, I think.
We'll definitely be getting him on, I think, to certainly reflect back on earnings season once we start getting some numbers through from that. And then the other thing I just wanted to pick up with you was, there's been a lot of sort of negative not publicity, but reports about the decline of active investing and how good passive funds are, or index investing is, compared to active investing. And you've slightly sort of started to perhaps take a contrarian view on that, and maybe that it swung too far towards passive. And I think, I don't know, we talked about it actually a few times last year, certainly on the 31st of October, if you want to listen back to that, particularly in relation to the dominance of the Magnificent Seven. And I know that you then sort of were quite sort of critical of one report that came out on, I think, well, we spoke about it on the 7th of November. And then again, it was one of your big surprises for 2024 when we recorded that episode on the 12th of November. So kind of thoughts on that. Are we seeing perhaps that, well, a movement away from, I mean, are there active funds that are actually doing well?
Yeah, so you're right. So myself and Coutts, actually, we've been big advocates of index investing for quite some time. And look, hard to, on the equity side, I should say, hard to call, but with a couple of things, is the concentration of the Magnificent Seven and Berkshire Hathaway in the index at circa 30%. The huge flows into passive. And, what got my contrarian instincts interested were, comments from the, along the lines of from the likes of Aberdeen, saying we've virtually given up on straightforward equity investing. And I get it, because it's been so difficult. And yeah, just making the call that it's going to move closer to maybe where active bond investing is. As it happens, I should do a call out, and this is not necessarily anything to do with what's inside Coutts portfolios, but two relatively high profile names that outperformed in really difficult environments. In US equities, Finley Park outperformed. The broadening of the rally, and that's another theme. The rally started to broaden away from the Magnificent Seven. So they outperformed US equities, which was really hard market to outperform. And in global equities, Capital International, their new perspective fund, also outperformed. Again, global equities dominated by the US. Again, really, really hard more recently to outperform. So credit to those. There were others. Apologies if I haven't mentioned others. And this is, as I say, this is nothing to do whether they're inside or outside Coutts portfolios. They're well-known name. Both of them are well-known names in the wealth management industry. Maybe less well-known to your average UK investor, those names, but I just thought I'd mention those. So yeah, I think, and it certainly started that way. And no, look, for the average investor, an index fund, is that a good investment? Sure. But it goes to show, if you put a bit of work into fund selection, and especially now, maybe we can get closer to 50-50 instead of those ridiculous numbers. Just as a reminder, Sarah, we talked about over 5 years, it's got close to 90% of active managers underperforming in the US.
Yeah.
So I can really understand why the likes of Aberdeen and others have virtually, if not given up, virtually given up on that. It's been a ridiculously difficult space, but maybe it's gone too far. It's very speculative. But yeah, we made the call in November. It's nice to be right. Sometimes you just are right. Better to be lucky than good.
Yeah. And as I mean, Alan, there you mentioned a couple of specific funds. Those are not, of course, recommendations from us, and they did well last year. They might not do as well next year. We don't know, do we? We'll have to wait till we get to the end of 2024 for that. All right, and then the last one then, before we get to sort of the main sort of meat of the podcast, is it's the FTSE 100's 40th anniversary this week, isn't it?
It is, yeah. And Sarah, before you say anything, I was not working then in 1980.
You beat you to it. I was just about to ask you. You must have started your career then, didn't you?
No. It was a couple of years later, to be fair. But no. So, yeah, look, I mean, FTSE 100, a great concept, because before that we had the FT 30, a bit like the Dow Jones. And so the FTSE 100 has worked well. Obviously, for people who've looked at it in the last 10 years ago, people think somewhat disappointing. But actually, since 84 to about 2011, in line with the US market. This underperformance is a recent phenomenon. And to be fair, it's not just the UK. Obviously, Japan's in there, but also Europe. It really is about the US being an exceptional market and having exceptional companies, including Apple, of course, that we just talked about. So it's not necessarily a UK thing, but yes, 40-year anniversary, and yeah, has lagged recently, but it's still been a pretty good investment in the long run.
Okay. All right then. So that's the sort of little bits and pieces out of the way. Now, what are the three things that we want to look at this week then for investors?
Well, Sarah, I'm glad I enjoy reading research, because at this time of year, the 2024 outlooks, I swear there's more than ever. And look, we've got one coming, haven't we, Sarah?
We have.
We're going to
Yeah.
explain the context of this, and when are we going to bring ours?
Yeah. Ours is being published the next, if you're listening to this podcast sort of in the first week in January, I believe it's going to be the Coutts Outlook is being published in the second week of January. We're going to have Monique Wong on as a guest to talk about that and get the sort of Coutts view of 2024. But what you've been doing is you've been going through, I don't know if you've gone through all of them, probably that's not possible, but you've been reading some of the sort of interesting forecasts for 2024, and are you going to break it down into three sections then, so we stick to our three rule?
Yeah, we stick to our three rule. That's, since you invented that, Sarah, no one's allowed to break that.
No,
No
absolutely
one.
not.
So I would say, look, interestingly, very quiet about FX.
Okay.
Some decent forecasts on commodities, especially gold. But I guess we could break it down to economics, which is, growth and inflation, if you like, where people do that. And then there's going to be some crossover, bonds, government, higher quality bonds, and then kind of equities and credit go together. So breaking it down into those three. Yeah, I've read a lot. I mean, JP Morgan, Morgan Stanley. I should give a call out before we get into the main course. Saxo do something called Saxo's Outrageous Predictions.
Hey, these sound good.
You can Google it, and just to give a couple, one made me laugh, and one actually made me think. It's a little bit close to when we played homage to Byron Ween in terms of, or recently sadly departed Byron Ween, in terms of his surprises. But Saxo take it to the next stage. So, for example, one of the things they said, as the world embraces obesity wonder drugs, and I'm sure everyone's been reading about those, people stop caring about dieting and exercising. Not me, I'm never going to give up tennis or skiing. Figuring that the drug will solve all their weight loss problems, and therefore there's a health crisis as people get obese before the drugs. So that was a funny little thing. But one thing they said was interesting. Second thing is that with the US budget deficit spiraling to above 10%, which is not impossible, it's currently about 6.5%. Congress makes income from government bonds tax-free under intense pressure from Donald Trump, kind of plagiarizing a bit, to get more demand for US treasuries. And I thought, yeah, actually, I can see that happening. So there we go. So Saxo's a bit of fun in there. But yeah, so, well, there's an awful lot to read. And the interesting thing is, this is all in the public domain. So it's all pretty Googleable. I mean, a lot of research is that either we pay hard cash for here at Coutts, or we have to be a client. But the major investment banks and the other, the asset managers, etc., put it in the public domain. So shall we make a start and get on with it?
We should do. Yeah. So, because I suppose my first question before you even start is, because 2023, as we said at the beginning, was fairly pessimistic. It was hard to find, optimists in the first half of the year. Has that changed? Now we had this fantastic end to 2023. Is the outlook for 2024 looking any better?
It is a little better, but for example, starting in economics, Bloomberg has a survey of economists. Again, and 85% of them predict a recession next year. But guess what? They did exactly the same in 2023. Now, these are economists that don't necessarily work at investment banks.
And we're talking US recession, aren't we?
Yeah, we're talking US. So yeah, thanks for clarifying, because it's all about the United States. For example, I've read Macquarie, the Australian investment bank, who are very bearish. Europe, UK already in recession, more to come. So I'll shout out some names who are very bearish just on that recession. We've seen it all before. Allianz, quite interesting, the German insurance company, we expect a recession in the US. They say in a break from the consensus, we expect a recession. I know what they're getting at, because this economist survey, I do wonder about it a little bit. And kind of the main arguments are, and JP Morgan, I'll use JP Morgan as well, is that the yield curve, so the US yield curve inversion, it's still a good indicator, and we're simply too early. And JP Morgan push hard on that. More generally, the impact of rates will have a big impact on the consumer and the corporations eventually. And also, there's a bit of pushback, which is kind of related to bonds a bit, a pushback that inflation really will fall so sharply, and inflation will be sticky around the 3% range, and will be difficult to cut. So that's kind of the bearish kind of argument. But on the more positive side, Capital International, actually, they're the firm behind New Perspective Fund that I mentioned. They had a very interesting piece, a thoughtful piece, and said, well, why we won't have a major recession is because we're already having many rolling recessions. So housing, obviously, last year, we had one in travel, we've had one in the oil sector. So various sectors have had rolling recessions and have been masked by the overall data. So and then just on the bullish side of the economy, the consumer and household are just strong excess savings type argument, and the Fed is right. The Fed's going to be easing anyway, which is going to support growth. So that's the bullish side of the argument, and people like Anatol Kaletsky. You and I met Anatol Kaletsky. You joined us, didn't you?
I did. Yeah, that was fascinating, because he actually was one of the few that called that we wouldn't get a US recession last year, wasn't he, if I remember correctly?
Yeah. Shout out to him, because he called it right, and he said, "Stop this ridiculous fascination with the yield curve," didn't he? That was one of his main arguments. I mean, it was much more sophisticated than that. But he's pushing back there. So one of our surprises was that inflation could be a lot lower. We don't really know. We put it out there as a surprise. So I guess, Sarah, we need to be forward-looking. We always get praise, don't we, from clients when we're more forward-looking.
Definitely,
ourselves. So we'll get this is nothing to do with the official Coutts view. This is me like summarizing the views that I've read on economics. I'm going to go with a soft landing, and as a bond person, as an ex-institutional bond investor, that pains me to go against the yield curve a bit, but just with the Fed easing and the consumer in pretty good space, and don't forget, these gains in markets translate to consumers as well. Equity investment is very strong in the United States, which is another subject I'd like to cover another time, about various countries.
It's at record levels now in the US.
It is. I mean,
it's something like 56% of households invest either directly or indirectly in equities.
Yeah, exactly right. And the UK is terrible in comparison. I think you and I need to cover that in more depth.
Definitely,
it's a worry for the UK, and it's great for the States. So I'm going to look, everyone has a bias, okay, and I'm going to talk about some investors who have a bias, including me. My bias tends to be on the optimistic side in terms of earning risk premium, and so I would lean against recession, and I would say, remarkably, I'm going to go with Jay Powell and the soft landing and some rate cuts supporting the economy.
Okay, I guess I don't know whether maybe we'll want to pick this up at the end, but you sent me an interesting piece by Joachim Clement, and his argument was that there is the strategists, and I'm guessing would he include economists in that, they're chronically pessimistic.
They are.
Whereas if you do sort of bottom-up research, which I'm assuming, correct me if I'm wrong, is where you kind of do analysis of specific companies, a little bit like sort of Howard and Richard, our colleagues. They tend to be more optimistic.
Yeah, they do. Yeah, and by the way, is that how you pronounce his name? Because you know you have a bit of Germany. I call him Joachim. Is it Yo? Have I been pronouncing
Joachim?
it wrong?
I think it's Joachim.
Oh God,
If
yeah.
if you're listening,
Yeah.
Joachim, please correct me if I'm
I,
wrong.
I will send it through. So yeah, so he basically he did a really interesting piece. He has a great newsletter, by the way, which I subscribe to. He wrote a very interesting piece and basically said, generally strategists, for whatever reason, are chronically bearish. And we're seeing this right now, for example, the two big bears out there today are Morgan Stanley and JP Morgan. And he looked at, on average, so this is taking some negative returns from equities. This is looking at equities, negative returns on equities, positive returns on equities. On average, the forecast is just 4.5% a year on equities, whereas the US equity market's compounded at closer to 10. And there is a behavioral aspect about being bearish, and we saw this, didn't we, last year with Michael Burry? It's just a much more
Yes.
intellectual argument
Yeah.
compared to my. Let's do a
Well, I
thought
was going to.
experiment.
Yeah, it comes across perhaps as more profound and more intellectually rigorous if you're negative. Whereas if you are an optimist and positive, is it just that people perhaps take it less seriously because they just think, oh, it's just Alan being positive again?
To a certain extent, I think that's right. Although the data backs me up, just like Joachim said.
Joachim.
Thank you. Please correct me every time. It's just I used to play tennis with someone I used to call Joachim. Maybe I was calling him wrong all the time, his name wrong all the time. Anyway,
One of us is wrong.
Just very briefly, I'll give before we get to equities properly, I'll give an equities bullish and an equities bearish case. So an equities bullish case would be equities are a growth asset, recession less likely based on the strength of the consumer. There's a broadening of a rally outside of the Magnificent Seven, and equities will deliver in the long run. Okay, so I made it purposely weak. In contrast, okay, change tack. This is gonna be different for me. You need to, Sarah, price in serious geopolitical risk, especially on the China-Taiwan nexus. You need to price in the potential to a 50 to a 70% downturn, and therefore we need to act accordingly. Even though that's a relatively low probability, we need to take that into account. 1, 2, cyclically adjusted price earnings ratios. This is where we take the current earnings, we spread them over 10 years, we do it properly, we take out the cycle. Shows US equities are the most expensive really since basically 2000. And then when we compare those equities on this basis to bonds, equities look ridiculously expensive. The risk premium is very narrow. This should indicate a very bearish forecast. Which sounds more compelling?
The latter one,
Alan will bearish, Alan.
Yeah, I mean, I'm not naturally bearish, but that sounds much more compelling because it just sounds you're throwing a lot of jargon at me. You're throwing a lot of data at me, or it sounds like you're throwing a lot of data at me. It sounds much more compelling than it's all going to be great, to paraphrase.
Exactly. So there you go. So that's where the bias is. And to be fair, I mean, it must be wonderful to be like Dr. Michael Burry from The Big Short, who made, we say in all humility, oh, look, all I am is a kind of long-term investor taking risk premium. But he called 08, 09, as did others do. Those people who call the 50% corrections, amazing, absolutely amazing. Just and when they do it and they speak again, you've got to be interested, right? And a bearish case can be compelling, but the reality is equities work in the long run. In fact, John Authers is another person we read who works at Bloomberg. He does a newsletter, and he even said he came on recently and said I should put a disclaimer, because we do a disclaimer at the end of this. He says he should put a disclaimer at the end of his reports because he has a bearish bias, and he's super clever, very interesting chap. I think he was he holds a record, University Challenge, the television program.
Yes.
When he was a student, he was on that, and he holds the record for the highest score on it. He's super intelligent, but a huge bearish bias. But he says I should have a disclaimer. Note, despite what you've just read, equities tend to go up in the long run. It's a bit different from our disclaimer, isn't it?
So essentially, then, what we're saying is that the bulls are right more often than the bears.
They are, and yeah, we're going off track here. That's another kind of really long discussion about why does investing in companies work in the long run? Not necessarily everywhere. We just mentioned the FTSE 100. It's been fine, but not stellar. But let's get back on track. We better switch from economics to bonds
Yes,
and then
we
equities.
had. Yeah, so before we get to that, so then sort of summarize then as far as the forecast, what they're telling us about 2023 as far as the economy goes, and we're talking obviously predominantly about the US economy, we've got 85% of economists are predicting a recession in the US, which is kind of roughly about the same number as we had last year. Didn't happen. Alan is being positive. He's sort of predicting, he's in line with Jay Powell, Fed chair. We're going to see a soft landing in 2024. Okay.
Yeah.
All right then.
I guess
Okay.
deja vu all over again, as someone, a famous baseball coach once said. Yeah, I mean, look, I'm putting myself at risk, but hey, let's go with it.
Okay. So what do you want to look at next? Do you want to do bonds
So
or equities
bonds,
next?
so bonds, it's kind of related to the economy, but go with bonds. Howard Sparks made a great point. You know, last year you couldn't find an equity bull. This year you can't find a bond bear. I did find one. It's Anatol Kaletsky again. I'll go to his, but he's right. It was really hard amongst the JP Morgans, Morgan Stanleys, the Deutsches to find generally a bond bear. And
what does that translate into markets? What does that mean if you're
so
bearish?
what that means, Sarah,
bonds?
is that you earn so a bond bull means you earn the income, say in the US, 4.5% to 5%, but you get some capital gains on top as yields fall. In terms of how I think how it is spot on, but you know the forecasts for falls in yields, so drops in yields, drops in interest rates are relatively modest on bonds. I'll come back to cash rates, but enough to give some capital gains. So, for example, one of the biggest bond bulls out there is PIMCO, the very large bond manager. You might say, well, they would say that, but
well, yes.
Well, I'll cut them some slack because also they're big managers of credit. So if their scenario works out, credit may not work quite so well because credit is more closely correlated with equities. I mean, but basically, yeah, I mean, this is interesting. They have a huge bias to not take credit risk, and they love mortgage-backed securities. And they've got some great long-term charts in there. They take the equity risk premium back to 1926. You know, we talked about the equity. So equity risk premium is the valuation of equities compared to bonds in very simple terms.
Yes.
In very simple terms. And I've criticized before some of the short-term graphs that people use. To be fair, PIMCO go way back in time. But again, they use CAPE, which is the 10-year average, okay, which is very flawed, okay. Intellectually, it seems so amazing. It's the 10-year average of earnings, cyclically adjusted price earnings ratio. The trouble is, earnings 10 years ago is so different from earnings today. Again, that's a whole discussion. And they basically say, look, equities are much less attractive than bonds. Bonds is where you want to be. Second, quite sophisticated point they make out is that there's very low volatility in equities at the moment. You're not paid for selling volatility or experiencing the risk premium. So receiving the risk premium in equities, you're really paid for receiving the risk premium. And mortgage, they've got a great chart on mortgage-backed securities. That's big in the States. That's why it's a 30-year mortgage market in the States rather than here. And I think they're probably right on that. Mortgage-backed securities look really, really attractive. But that makes them very, very cautious about credit, or very cautious about credit, because they expect the business cycles to go down. Similar kind of arguments to what we heard really earlier about bonds are going to really bite. Sorry, interest rates are going to bite in terms of corporations, the yield curve inversion, and rates are going to come down. So that's kind of the bull case. The bear case is Anatol again. And Anatol says basically, amongst other things, best case is that rates go to 3 to 3.5%. But on average, 10-year yields need to yield, sorry, cash rates. Cash rates go to 3.5, down from 5. But bond yields need to yield 100 to 150 basis points more. And therefore, the 10-year Treasury should be 4 to 4.5 anyway, and it's below that, and it's very, very, and therefore they're very expensive. Plus, we've got a huge amount of supply. I'm going to get the most downloaded financial app. Remember the US
Oh,
debt?
yes. You're still
The,
looking at that. You're still checking it every day, Alan.
Yeah. So the deficit, at least based on this, is 6.3%. But about 20 to 25% of the US Treasury market needs to turn over, also need to be sold next year, matures and it's relatively short duration market. So there's a huge amount of supply coming of government bonds. It's not a problem when inflation's very low and there's recession. But if there's not, which is what Anatol's kind of leaning to, you need to have a premium on 10 years. And you can probably tell by my voice, my bias is leaning with him. So what does that mean? Actually, a year very much like this year. You earn quite an attractive level of income, but don't push maybe for the big capital gains. Maybe a good hedge against a recession, but only a hedge, and rather than if you like a core strategy.
But it's fair to say then that is a minority opinion then, because the consensus then from what you're saying is that actually most people kind of see the valuation of bonds going up this year and yields coming down.
Yeah. So whether it be Morgan Stanley, JP Morgan, Deutsche Bank, many others that I've read see basically high quality bonds, governments and investment grade, yields falling. So some capital gains to top up the income. It's entirely possible, but my bias would push me more towards Anatol's analysis.
Okay. And then obviously the flip side of that is the outlook for equities. So what is all the research? What are the forecasts telling us then about 2024? What's the consensus?
Finally, we get there to the core. And we're talking about US equities. Other markets do follow. So our friend Tom Lee from Fund Strategy, the only analyst to get it right, he's positive. Again, there's a guy called Ed Yardini who puts out, again, this is all in the public domain, 9 good reasons to be positive equities. So there are bulls around, and even Merrill Lynch Savita Submarinian, apologies if I get her surname wrong, top equity strategist at Merrill Lynch. She was very bearish at the start of last year. She cleverly switched in the summer, and she's reasonably positive. So there are bulls around this year, Sarah, in equities, but there's 3 huge bears, and very respected bears, top names: Morgan Stanley, JP Morgan, and Deutsche Bank, more their credit team. But these are 3 huge, well-followed analysts who are still very bearish. And so, yeah, interestingly, more mixed this year.
Okay. And obviously with 85% of sort of those sort of questioned predicting a recession, I guess that is going to influence then that slightly more bearish outlook on equities, isn't it?
It is, to be fair, that necessarily different peers, because a lot of those economists may be at Wharton Business School, Harvard Business School, etc., as opposed to working at Morgan Stanley and Merrill Lynch. So different peers. But yeah, I'll just run through the bearish case, amongst others. Serious geopolitical risk. Some people do mention that, and elections, of course. Basic argument is, again, the equity risk premium argument. Of course, no one's saying that US equities are cheap. Equity risk premium stretch. But the main argument is tougher economic, is exactly as you say, Sarah, tougher economic times to come, earnings to be under pressure. The yield curve is still a great indicator. And JP Morgan, I think it was JP Morgan who did some work and basically said, look, the yield curve signal works well up until the second half of this year even. So since the yield curve first inverted in the States, it works well into the second half of this year. So they're standing there by their guns, the bears. The more bullish ones focus on rates, the Fed pivot, which we covered just before Christmas. The Fed pivot is remarkable. Fed easing, the market loves it. Yes, there's a lot priced into the bond market, but less so equities. And inflation looks to be under control. Ed Yardini makes the great point: corporate cash flow up 4% year over year, corporations generally in a good space. And basically markets can live, and we're talking about the United States, markets can live with this relatively higher valuation. And I suppose it's maybe worth saying that it's not all about the United States. We focused a lot about the United States, but the rally last year was broader. Those sitting in the UK may think, well, what equity rally? But Japan was a very strong market.
Yeah.
Europe was a strong market. Yeah. And yes, the US was narrow, but it was a broader global equity than credited. You know what? So that's the bull and the bear case.
Is it? Are there more bulls then this year than there were going into 2023?
Definitely. Honestly, I could only find Tom Lee last year, and he called it exactly right, 4,700. And he called. And by the way, was it only in November there was a Goldman Sachs survey of professional investors, so people on our side, over 1,000 investors. And I think the numbers were really small. 10 to 20% of investors saw the S&P over 4,400, and it ended the year at 4,700. So it's not just the strategists out there, but it's investors, frankly, like ourselves, who are in the same business as ourselves, that have been very, very bearish. So there are more bulls. So, contrarian instincts means, should we lean against it? But, not enough. It's not a bullish consensus yet. You've still got the especially the powerhouses of Morgan Stanley and JP Morgan absolutely in the bearish camp. But look, we've had a great run in equities, right? Yeah. We're probably overdue a 10% correction.
Yeah.
Which happens, Sarah, now. How often does a 10% correction happen?
Well, it happens about once a year, doesn't it?
Exactly. So, maybe we'll have it early this year. Who knows? We don't really know. Luckily, my job is not short-term forecasting or short-term investment management. The role I have is much more longer term. And that's my natural way of allocating assets anyway. So that is it in a nutshell, 2024. So my bias would be, rate cuts dominate. I'm with Jay Powell. Rate cuts will lift the market higher, but it's not maybe going to be as euphoric as last year. Last year was euphoric, and a bit less euphoric because a lot of people have bought into it. And active investing. All my fund management friends will be so delighted. Active investing is back, but I really believe it. And this is someone, that started a business 12 years ago, put nearly all the money into passive. So, but I do believe it's gone too far.
Thank you very much, Alan. And I'm glad you spent your entire break over Christmas and New Year reading all that research so that we didn't have to. Thank you very much. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. As I said, thank you very much, Alan, for joining me today. Until the next time on Need to Know, bye for now.